Good morning, everyone, or actually good afternoon at this point. Can you hear me?
Yes.
Yes.
Yeah, great. Welcome to this afternoon's educational session.
Tara, there's some sound going on, a man talking in the background. I don't know if someone has a radio on or something.
Okay, I'm gonna mute everybody. Okay, that is better. Great, so welcome everybody to today's educational session. We call these gatherings continuing the conversation, and it's very intentional. This is just a conversation that we're inviting you to participate in. We're not prescribing or subscribing to any view. We're sharing information. You're the architects of your future and what you choose to do at NewBridge on the Charles. We just want to give you the tools so that you can make your best decisions moving forward. So today we're going to be talking about the financial component of our continuum of care. And we have Rob Faria, who will be our speaker. I just want to tell you briefly about Rob before he takes it away. So Rob is the Assistant Director of Finance for NewBridge and Orchard Cove. He has his BA in accounting from Bridgewater State and his master's from Regis. He's worked in finance and accounting for the past 25 years, 4 of them with HSL. Before coming to us, he was in the for-profit world, very different from our nonprofit. He enjoys running and being outdoors when he is not crunching numbers, which is his expertise. So briefly, I want to give you an overview before Rob starts. He's gonna share with us a bit about how NewBridge is leveraged financially. He's gonna explain what it means that we are not a life care model. He'll talk about costs across our continuum of care. He'll talk about modified life care option. He'll talk about long-term care insurance, and he'll talk about how the entrance fee can be used down the line should you want to use your entrance fee for care in our continuum. If you have questions, would you please put them in the chat? There will be time at the end as well for people just to raise their hand and ask in real time. Okay, Rob, I'm gonna just pass the ball right on to you.
Great, thank you so much, Tara. Can everybody hear me okay?
Yes.
Okay. Welcome, everybody. I know you're all busy in your day-to-day lives, and the fact that you want to listen to me is a compliment to me. Usually in finance, people don't look at us as fun to talk to, but I will make this as fun as I can. So in terms of the introduction that Tara just gave, in terms of looking at NewBridge in the model that we are, when you think about continuing care retirement communities and they're remaining sustainable and vibrant, there are different factors that NewBridge leverages from a financial perspective to allow for a continued stability, continued sustainability and vibrancy. We have our monthly service fees that you all know and love, that help us support our operations. So that allows us, to support things that you see on a day-to-day basis, whether it's culinary, security, transportation, housekeeping, etc. Then we also have situations with net entrance fees received, as well as the investment income that we get on those net entrance fees received. As you all know, that entrance fee stays with us until you exit the community. And we utilize those entrance fees as a way to garner investment income.
This is not going to help me.
Oh, sorry.
We need to get it updated. We'll have to go to somebody.
I have all the papers now.
Sorry, I think somebody's speaking.
Everybody has to be muted.
I just muted everybody, Rob.
Okay, so now can you just Can you hear me now?
Yep.
Okay, perfect. So in terms of, the investment income that we gain from the net entrance fees received, along with the net entrance fees received that we obtain every year from move-ins, that allows us to support the infrastructure of NewBridge. As you know, NewBridge is now over 10 years old, and so it's important for us to maintain the look of the campus and make sure that it's not viewed as, an aging facility. So that's how we build, how we've designed the model for NewBridge. There are other communities that are similar in nature, like a North Hill that I'm sure you've heard of, that operate on a similar premise. There is other models out there that you may be aware of. There is the rental model, which bypasses the entrance fee, but naturally the monthly service fee or rental fee is much, much higher, easily 2.5 times what you're paying here at NewBridge. There's also the life care model. The life care model, which is part of our sister community at Orchard Cove, which I also manage, which is unique in the sense that you are offered the option of, I will call that insurance. You pay a monthly premium where that premium goes towards future care in the continuum, if you so choose to move through the continuum at a greatly reduced price. So, for example, if you were to move into assisted living in Orchard Cove, you would pay what you were paying in independent living plus a small surcharge in exchange for the monthly premium that you've been paying. But as Tara had mentioned, we are not a life care community. We are not a rental model. We are, a modified life care community, basically in effect. In terms of the item number, Tara, if you want to put up the slides for AL pricing as we talk about continuum care here at NewBridge. Thank you very much. And so as we look from a financial perspective, in terms of continuum of care at NewBridge, without the modified life care option, moving through the continuum, you can see here what the pricing would be for assisted living. The community fee is only for outside admissions, so you can ignore that, but you kind of get a sense of the pricing for what it would be for a 1-bedroom or a 2-bedroom. And when you compare that to what you're paying in independent living, obviously it is a little bit more a month, but you can see as you scroll down, there are many different services that are provided, which Tara, I didn't know if you want to dive into this for a minute or two.
Rob, let's keep going and we'll tackle that a little bit later.
Sure. So again, this pricing that you see here is if you're not part of modified life care. This is if you were to transition from independent living to assisted living, and in this case, memory care assisted living. You can see the pricing here. Again, a little bit more than independent living, but there's naturally reasons for that based on the services that you are provided from that perspective.
I'm going to pull up the healthcare as well, Rob, okay?
Okay. Now, here's the one that'll probably make you fall off of your seat. So in terms of the healthcare center, as you can see, this is pricing for Rosendale and Dedham, but you can see that the two are not that far off. And the cost of whether traditional long-term care or memory care long-term, as you can see, is upwards of $600 per day. Naturally, that translates to around $18,000 per month. So it is, like any other facility, pricey. And so without the modified life care option, you would be looking at these types of prices if you chose to move to long-term care within our campus here in Dedham. The other option that we can talk about in terms of, to talk about Medicaid, when you think of, going through the continuum, and you've exhausted all your resources, so in other words, when would Medicaid be an option? What we typically do is try to work with the residents to keep an eye on their source of funds or what they have in assets, and make sure that those assets are adequate. When those assets are starting to run low, typically within 6 months, if they're down to about 6 months worth of funds, we typically engage in conversations to talk to them about Medicaid, and whether they are eligible for Medicaid. And typically, if they are eligible, then it's then covered by Medicaid. However, one of the things we talk about is if you're in our continuum of care here and you do qualify for Medicaid, it is not a guarantee that you will stay within the NewBridge campus if you were to move to long-term care. It's a high probability, but we fall short of guarantee because we can't guarantee that a bed will be available and so on and so forth, and the timing of when you would transition under Medicaid. So it's an important thing to remember. People have mentioned that to me in the past, that they thought it's guaranteed because I'm a resident at NewBridge, but unfortunately it's not necessarily a guarantee. It's high probability, but not a guarantee. So there is a small but important difference there. So one of the things that we also watch in terms of, or actually, I was going to go on to the topic of private health, but Tara, I didn't know if you wanted anything to say on the previous slides or.
I think what you were asking of me earlier, Rob, was to speak a little bit about, why the costs were higher and what the difference is if you make a decision to stay in independent living with private help. Depending on how much private help you have, either you'll be paying more than it would be for you to transition to another area of our continuum. But it's really a decision that you would want to make knowing that it's apples and oranges. So staying in your independent space with private help is a great solution, but it's a solution that doesn't provide an entire team of experts to provide support for your needs. So it's a choice that you make. You may decide that you would prefer to stay with your caregiver. That's totally fine. But know that you're paying, there's a cost to that. Not a financial cost necessarily, but a cost in that you're not receiving the entire village of expert caregivers that you would get in assisted living or long-term care. Rob, that's just the point that I wanted to make earlier.
Great.
Thank you.
Thank you.
Yeah.
So just to piggyback off of that, in terms of the private care that Tara was talking about, that is very pricey. So, when you look at the market today, you're talking about $30, $35 an hour for outside help to come into independent living. And if you were to do the math, even if you ask for 10 hours a day, that's $350 a day. And so per month, you're talking north of $10,000. So it does get pricey. And while it's not apples to apples in the sense that in assisted living, you wouldn't necessarily get that same 10 hours of care. However, you would still have care along with additional services that are outlined on those pricing sheets that will be shared afterwards with you. I think I saw a question pop up. Let me see.
Yep. If you're on Medicaid and a NewBridge resident, are you guaranteed a space somewhere in the HSL system?
So what I would say there is, again, highly probable, but not guaranteed. Unfortunately, that's not something we tell folks that, it's not a guarantee. It is something that more than likely you will find a bed in Rosendale if it's not here. But we don't want to provide false narratives to say that, oh yeah, for sure. Because there's always a chance, be it a small one, that you would not be able to find a bed in our suite of campuses, if you will.
And I think you're right, Rob. It's a very small chance. I've not actually seen that happen in my tenure here. However, there is the possibility if you preferred NewBridge, but there wasn't an opportunity here, you could temporarily go to Orchard Cove or Roslindale if they had a space and then transfer back. So we try and be creative and look at all solutions that are on the table.
Mhm. Good. So going back to the private aid, so obviously that's something that from a financial perspective, I look at and say, it's not financially sound, if you will, from an independent living perspective, because you are paying quite a bit of money for outside help that could be, to an extent, provided in our continuum of care. So again, when you look at $30 to $35 an hour that you'd be paying for external support, it does add up very quickly. The one thing you'll also hear, and it's a very important point, is if you have modified life care, that does not cover private help. And also, if you were to draw on your on your entrance fee, which I'll talk about in a little bit, that would also not be allowed to be drawn from your subsidy. So, there is a reason for that. I think it's to try and not necessarily discourage, but make sure that if you're an independent living community, that you're enjoying your best life and moving through the continuum of care when the time is appropriate.
Rob, we have a question from Paul. Where does the big down payment, when we move to NewBridge, how does that relate to Medicaid?
So the down payment is included, if this is what you're asking, in the when they think of what you have for assets. So that would also have to be exhausted before qualifying for Medicaid. So that's an important thing to factor as well. Is that still considered an asset of yours? Even though technically we're holding on to it, they would need to see that it's been utilized as well before qualifying for Medicaid.
Good, thank you.
Mm-hmm.
So in our agenda, the next section was about modified life care option, and Judith had a question about it. So why don't we shift over to that now?
Sure. If you want to pull up the...
Sure. Let's find it. There we go.
All right. So the way modified life care works at a high level is that typically at the time of move-in, we do allow a grace period of up to 60 days after move-in for you to choose modified life if you declined it initially. And what the process involves is there's an entrance fee that gets paid. If it's single, it's $150,000. If it's a 90% contract. And for a couple, it would be $225,000, 90% refundable. The other thing about modified life care is there's no, pre-qualifying or health check, if you will, that is done to allow you to select the modified life care. So if you want it, you can have it. Whereas a good example is Orchard Cove, because that is viewed more as an insurance where they pay a monthly premium. There is a health screening done initially to see if they are eligible for that life care program. But with modified life, there is no health screening initially. So what it does is it basically gives you some of the benefits of the long-term care insurance policy, which we'll talk about in a little bit, but not to the extent of a long-term care insurance. It's called quasi-insurance. So what it allows you to do is, if you were to choose the continuum of care at NewBridge, for the first 120 days, whether that's in assisted living, memory assisted, or in long-term care, you would be paying what you were paying in independent living. In the case of once the 120 days are through, you basically you get a 20% discount. And so 20% doesn't sound like a lot, but when you think about long-term care and that cost of $18,000, that would allow you to bring that cost down to, if I do the math right, $14,400. So it does save you more, and you'll see, thank you, Tara, if you scroll down, there are savings in assisted living, but when you look at, again, the costs of long-term care, you can see how much the savings add up there. And again, the what you put in, the 150 or the 225,000, is 90% refundable. Again, assuming you chose the 90%. I have a question here. Does preferred probable not guarantee apply to physical therapy? I don't. Well, I guess is the question that if you needed physical therapy, would it be provided to you?
Yeah, Mark, can you clarify the question? I think anything that Rob has talked about thus far doesn't cover physical therapy. That would be Medicare or your private insurance, not modified life care option or long-term care insurance.
Yep, that is correct.
Yeah, and then Carol had a question. Can you only choose this option for 60 days from when? Yeah, Carol, so that's from when you first move in. And then Michael had a question about how the numbers apply to couples versus singles.
That's a very good question. So with modified life care, when you have a second person moving through, it would be what they were paying as a second person as well. So it actually would be a little bit more advantageous there, in the sense that you would be moving through the continuum as a second person, and then paying that rate, and then the 20% off the full rate afterwards. So the bigger benefit to that is basically the first 120 days. After that, it would be the 20% off the full rate for assisted or long-term care. And Carol had a question on, I know most people have been here more than 60 days, which is accurate. I think part of and Terry can speak to this as well, this is more of an education for not only you, but also others, because there was a larger audience that was part of the invitation. Tara, I don't know if you want to go into that a little bit, or.
Yeah, so most people here have been a NewBridge for quite a while. Many of you have the modified life care option, and Rob sent personal invitations to you specifically so that you could be re-informed about what it offers you. And then the folks that are new to us, welcome. And if this is something that you were presented in your sales experience and you said no, you may reconsider. It's up to you, but you have the first 60 days to purchase it. Is there another question? Oh, okay. Carry on, Rob.
Oh, we have another one. For PT, again, that's more of a Medicare question, necessarily Medicaid.
Yeah, Mark, when you say, must I wait for an opening, what does that mean? You want to unmute yourself and you can just ask the question?
Oh, Tara, do you have to unmute him?
I gotta find him here.
I guess while you're doing that, I see another question popping up about the 120 days. It is the first 120 days. It does not renew annually. So once you're enter the continuum of care, it would be the first 120 days in that continuum of care. And then after.
Have I unmuted myself?
You did.
Oh, yeah.
You did. Yep, yeah.
Okay, my basic question, which is very personal. I called in for a PT appointment and they said it might be 2 or 3 weeks. Is that with my preferred status as being a resident or?
Ah, yes. Did you let them know that you were a resident of Newbridge, Mark?
Yes, I'm ready to go.
Yeah. Yeah, I'm sorry about that. You know what? Let's talk offline after the session, okay?
Very good.
Okay, thank you.
I'll
Thank
mute
you.
myself again.
Okay, thank you.
And just to finish off, sorry, the question from Bob. So the 120 days is the first 120 days. It's not something that resets on an annual basis. So after the first 120, you're at the 20% discount for the remainder of your stay. And even if you were to transition from assisted living to long-term care, that doesn't reset either. So it's really the first 120 days of your continuum existence.
Another question from Michael Ross, Rob.
Mhm.
Can the 120 days be divided? For example, if I go to AL, then come back out before using 120, is it cumulative until 120 is used?
That is correct. So it is cumulative. So if for whatever reason you went into assisted living and then had a change of heart or circumstances changed and you hop back into independent, we would stop the clock. And then if you were to go back in, we would restart it.
Great question.
Yes.
And I see your hand up. Do you have a question? I just sent you an unmute yourself request.
Can you hear me now?
Now we can, yeah.
I think, as I said in the chat, it's essential that this presentation be given to our children or our healthcare proxies, not to us, not just to us. And I think it's essential that you print out the screen shares.
Mm-hmm.
But I think that our children are going to be making these decisions for some of us, and they don't have the information.
So I think we're thinking alike. So all of the adult children email addresses that we have, which is about 500, they received the invitation for all of these continuing the conversation educational sessions. I'm sorry, I didn't understand. You're muted again.
My child did not get information about this, and I don't know how you get her email. But you can't do it in the middle of the day when they're working.
So another good point. And why don't we talk afterwards and I'll get your daughter's email address. We all also send a recording of any educational session after the fact, so people that can't join us can watch later. So let's connect later and we'll get that address.
Okay.
Thank you.
Yep. Thank you.
Yeah, of course. Okay, Rob, continuing on.
Okay. So the modified layoff option, as you've seen here, again, offers substantial savings in the event that you choose to utilize our continuum of care. So what I would do next, if it's okay, is to move on to long-term care insurance, which I always joke about long-term care insurance in the sense that it's the one insurance that you're probably more often than not going to want to use. Unlike, say, a homeowner's insurance policy, like I always joke and say, I pay for my home, I pay my insurance for homeowners and I never need to use it. So, it's not all of a sudden after 20 years of paying homeowners insurance that I'm just going to decide, well, let me put my house on fire so I can get some benefit from this insurance. In the case of long-term care insurance, obviously that's a different story. If you were fortunate enough to buy in at the time of its inception, that was a very good investment on your part. That's probably the reason why many of those organizations went bankrupt. And also why, if you're able to find long-term care insurance today, it's quite pricey. So long-term care insurance currently, when you look at our assisted living population, that includes memory assisted living, about 1 in 3 have long-term care insurance. And what this allows is it's modified life care at a much more robust level in terms of financial flexibility. in the sense that you get a daily rate, or the long-term care will pay a certain rate per day for your stay in assisted living or memory assisted living or long-term care, depending on the policy. And typically these policies have a 90 or 100-day elimination period where those days, those first 90 or 100 days are not covered. But then once that elimination period is ended, then you get the daily benefit per the insurance policy. And most of these insurance policies also have a maximum, a benefit maximum, which is either in years or in dollars. The ones I've seen usually are 3 years, 2 years. I've actually seen one that was quite impressive, which was unlimited. So that was a pretty good purchase on their behalf. So the long-term care is a great thing to have if you were able to get it. It's something that provides you with much more financial peace of mind, if you will, if you do move through the continuum of care. The one thing I wanted to say, sorry, that I forgot about modified life care, is that there is tax advantages to that. Obviously, where you're paying for future medical care, the possibility of future medical care, there is the ability to deduct that as a medical expense. I will not go into tax accounting because I am by no means a tax expert, but just know that there are tax benefits from purchasing a modified life care plan. Hopping back to long-term care insurance again, it's if you have it, it's great that you do, obviously, and it's one of those things that can be leveraged if you do decide to move through the continuum of care. So, and one of the other options we talked about, or to be talked about, is the concept of a subsidy on your entrance fee. So, and when you look at all the different options you have available to you, as you decide whether or not, if the time comes to move through the continuum of care, we've talked about modified life care, we've talked about long-term care insurance, we've talked about Medicaid, and there's also another option, which is to draw on your entrance fee. And we currently have, I want to say, about 10 to 15 folks that are on subsidies, not necessarily for transitioning for continuums, but just to give you a sense of how many folks in the community are drawing on their entrance fee. And it provides you with the ability to, like I said, draw on the entrance fee in order to pay for your care. Again, it does not include, it only includes what you would typically see on your statement. Anything outside of that is not covered or cannot be used to draw upon the subsidy. So again, the key there is private aids. That would be something that you would continue to have to pay, out of pocket. And so when you look at that, the one caveat with the subsidy is, if you rewind back to the beginning when I was talking about net entrance fees and the subsequent investment income that we generate to maintain a sustainable model here at NewBridge. There's also the drawback. If you then take from your entrance fee, you're now taking away money from us that would have created investment income. So in effect, we treat it as a loan, and there is an annual interest percentage. APR is 4%. So keep that in mind if you were to choose that path. And again, it can be utilized whenever you feel the need. One of the options is continuing with care naturally, but if for whatever reason you needed to utilize it in independent living, that is an option as well. And can be paid back at any point in time. So if you were to draw on your subsidy for a year and then your financial picture changes, you could easily pay that back to bring your entrance fee back up to its original state. So it is an option for you. It's one that you can again leverage when moving through the continuum of care, and with the understanding that there is a small interest fee that is charged on the subsidy, because I always make sure to say that, because I don't want to deceive people into thinking that there is no fee associated with the subsidy. So those are the different items that I wanted to discuss today in terms of the financial aspect of moving through the continuum of care and what options are available to you as you try to make that decision, or if that time ever comes for you. So Tara, I'll hand it off to you.
Thanks, Rob. Lots of information. So at this point, we'll open up for people to put questions into the chat or raise your hand if you want to ask your question verbally. That's great too. Something just came in. Is there a financial trigger point for beginning to draw on the entrance fee?
That's a great question. Typically, we or I wouldn't know. There's certain indicators that might tell me, oh, this resident might be in some financial difficulty. One of the things we monitor is our aging schedule. So in other words, our residents current with their monthly service fee payments. And if we start to see, some slippage, if you will, there in terms of, they're now 3, 4, 5 months behind, there is a courtesy call that is given to the resident just to state that, hey, we've noticed that your balance has grown, and potentially offer you the opportunity to use, your entrance fee to cover your cost of living at NewBridge. So.
Great. Any other questions? Serena, I just sent you an unmute request because you are muted. There you go.
I just want to clarify on the 90% refundable nature of the modified life care policy. That is, it would go to your estate after you die if you don't use that part of the, if you don't use any part of the policy, or how does that work?
Yep, exactly. It will work just like your entrance fee in the sense that it's 90% refundable, and at the time of your exit from the community, then that along with your entrance fee would be paid at the 90%, assuming that's the contract that you chose.
Well, when you say exit, do you mean your death?
I always stay away from that word.
Okay.
By exit, it can be either death or moving out.
Moving out. Okay.
Don't avoid death.
There's no way to avoid it. Rob, another question. Must the resident deplete other personal assets before drawing on entrance fee to pay expenses at NewBridge?
Typically, we say yes. However, the language in the residence in care does say that it's up to ultimately the executive director, in this case, Steve, to decide on whether the subsidy is allowable. I have yet to see one that he's declined. So I don't foresee an issue there because, again, we are in effect protecting the community by collecting interest on the subsidy. So while typically we would like to see that, that you are not like to see, obviously personally, but that you're running low on funds. But if you're not, it doesn't mean we won't allow it. So again, the safeguard there is the interest that we charge. So.
You've rendered them speechless, Rob. There's no more questions.
I see Bob Tuttenauer and Anna Marcus.
Oh, thank you. All right. Let's
Sal
go.
Barzilay.
I got to expand my screen here. Let's go for Bob Tuttenauer. Please unmute yourself.
Okay, unmuted, right? Great.
Yep.
I just want to make sure that I came in a bit late. If part of the couple, the husband or the wife, has to go into independent living and the other half remains in assisted living rather, and the other half remains in independent living, your independent living costs basically remain the same, and you're then picking up the assisted living piece. Is that right?
Correct.
Huh?
Yes, yes.
Okay.
Okay, I missed who raised their hand otherwise. Norm and Sid. Okay, if you could unmute yourself.
I feel like I missed a major point here. So we paid in the 200,000. We took advantage of that. From your chart, it seemed like we would save maybe 79,000. Was that the number? How do we get to the benefit of having put in $200,000 and possibly going over that? Do you understand my question?
Yeah, absolutely, I do. So when you think of it this way, so again, the key piece here is that it is, assuming in your case 90% contract, it's 90% refundable. So your risk, if you will, is the investment income that you've lost on that money. So if you were here, say 10 years, which is typically the average stay, and when you do the math, $200,000, and you assume 5% interest annually, that would be $10,000. So over the course of 10 years, you basically are forfeiting roughly, just call it $100,000 in interest. Weigh that with the pros, which is if you're in long-term chronic care for 18 months, or even 15 months, that basically covers the cost of the lost investment income, if that makes sense. So there's always risk, but I think in the case of modified life care, I would like to think that the risk is somewhat low because, again, the refundability portion of the modified life care fee itself.
Mm-hmm.
So what then, because of another question that was asked, so every January 1st, we can renew that every year it renews?
Yeah.
If you use it 1 year, then the 120 days the next year, and et cetera, et cetera?
No, I think, unless I misunderstood, it's the first 120 days. And then
Total
after,
in your life,
and then after that, it's 20% discount.
20%, okay.
Yeah.
All right.
Okay, Anna. You are muted. Anna, you're muted.
I think that when it is not clear when we enter NewBridge that the 90% that we assume will go back to our families is going to be a loan that you would take 4% out of. That is absolutely not something that is discussed when we enter NewBridge. And I have some serious questions about it.
I believe, I can't speak to the sales team, but I know that there is language in the residence and care agreement that talks about it. Again, it's the opportunity is yours to take if you so choose. And the reason why we treat it as a loan, again, is regarding the sustainability of the community. So, think of the most exaggerated scenario, which is everybody then decides that I just want to borrow. If we didn't charge interest, let's say, and everybody all of a sudden says, well, I want to start drawing on my entrance fee. Obviously we would take a significant financial hit there because we would be losing our ability to generate investment income and therefore compromise the ability to remain a sustainable community. So that's part of the reasoning behind it. As to whether or not, in your specific case, it was not discussed. Again, as a finance person, unfortunately, I can't speak to that. It would be more the sales team. But Tara, I don't know if you want to add anything or.
I don't have anything to add now. There's a cost only if you utilize your entrance fee. There isn't a percentage added if you don't use it. Okay. All right, good. You got that.
Yep.
Yep, Hal, you and I were on the same page. Good. Anybody else have a question? Barzilay. Okay. You are muted.
I'm muting. Now
There you go.
Okay, great. We are potential residents, and my understanding is, and tell me if I'm incorrect, that the entrance fee policy has been changed or will be changed shortly. Meaning that after we pay our fee, 40% will be taken by the institution. And then whatever is left falls in the categories as printed. Is that correct?
Sounds like you're opting for a 50% contract?
Whatever contract,
Mhm.
the institution will take 40% of whatever we pay in.
I guess I'm a little confused because it should be based on the percentage contract that you choose.
Right.
Yep.
So let's just take a sample. We pay $100 entrance fee. The institution takes 40%. That leaves us $60. And out of the $60, we will pay the respective percentage when we exit the institution.
Well, again, I think what you're describing, I apologize, sounds like a 50% contract. So if
No, that doesn't have to do anything with the contract. The fee that is paid, 40% will be taken off the top and goes to NewBridge. Period.
I'm sorry, I'm not understanding because you're talking about your entrance fee, correct?
Yes, correct. So pay $100 entrance fee, NewBridge will take $60 of the $100, no, $40 of the $100, period. And then the prospective math takes part of the remaining $60.
Yeah, the only thing I would push back a little bit on is the period, because and it's hard to keep bringing up the percentage, but let's look at it this way. That $100, if it was 90%, we'd keep 10. If it was 70.
The way the new policy will be, the 90% will be of $60 because the first $40 will taken off the top. That is the policy soon going to be in effect. Do you know anything about that?
That, as you can see, I do not. So,
okay.
Yeah,
because that was the salesperson told us that gave us that information.
Okay. I can follow up with them on that and see exactly what they were stating, just to make sure I understand where you're coming from.
Thank you.
Sal, who is your salesperson?
Pam.
Pam. Okay, great.
Yep.
Good. Thank you, Rob, for finding that out and connecting with Mr. Barzilay.
Yep.
Thank you very much.
And I have your contact, and Tara, I have his contact information just so I can follow up.
I can get it for you. And at the end of our time together, I have a slide with your contact information, Rob, so people can reach out to you one-to-one if they so choose.
Perfect. Thank you.
So I think Linda has a question.
This may not be appropriate to this particular discussion, but since I entered NewBridge 2 years ago, the fees for myself and my husband have increased exponentially, I guess I'd say. On what basis do you decide when it was like 2.3% when I entered, and I think this year it was 4.6% for memory care? How is there any limit to that? I understood when I moved in that nothing was guaranteed, but I also did not expect I did not anticipate the kinds of increases that I've seen in just 2 years. So on what basis or where can we find an explanation for the basis for increasing fees at whatever level they are increased?
Okay. That's a very fair question. I think for us, one of the things that we've been hit hard by when you think of the majority of our expenses for the campus lie in the services that are provided within, lower paying areas such as culinary and housekeeping in private aids. We've been significantly impacted by the minimum wage continued minimum wage impact in the state of Massachusetts, where that's been gradually increasing and will continue to do so until we hit the $15 an hour, and I believe at the beginning of 2023. Related to that is, the market compression that comes with it. So, if you had somebody, if the minimum wage goes up to $14.25 in January, and you've already got somebody making $14.25, well, then they need to be bumped up as well because, from an experience perspective and so on and so forth. So when you couple that, and not to blame COVID by any stretch of the imagination, but some of the expenses that we had to deal with due to the pandemic have been substantial, and we look to absorb as much of that as we can and not pass on to our residents. But I think the biggest driver is just the continued increases in the cost of labor and the associated benefits that go with it, such as medical and dental. Now, is it something that we can just continue, just decide to also have to keep in mind the market, right? So we're constantly looking at competitors and making sure that we're not pricing ourselves, if you will, out of the market. So it's not like we can just, continue to just willy-nilly increase pricing, because then obviously people would choose to go elsewhere. So, I hope I've answered the question, but the long story short is just the labor market is getting more and more costly for us.
Thank you.
Okay. Any other questions? No? Okay. I'm going to take the opportunity to just share Rob's information here. He has offered to make himself available if you wanted to speak with him offline about any of the topics that came up today or anything that you didn't want to share in public. Please feel free to reach out to him. And per Anna's great point earlier, we'll be sending a recording of this session to adult children. We're going to put it on our NewBridge YouTube site, so you can see it there as well. And one last opportunity to ask questions. Otherwise, we'll call it a complete session. Speak now or forever hold your peace. Okay, your peace is being held. Thank you, Rob, for your expertise. We so appreciate it. Thank you all for joining us, residents and families of NewBridge. And I wish everyone a good weekend and Shabbat Shalom to you all.
Thank you, Rob. Thank you, Tara.
Thank you. Take care, everybody.
Thank you.
For the slide.